Hello everybody, and I just want to thank you for tuning in today and joining us for the shifting real estate market. Hope you get a lot of value out of today's session. All right, so if you think about the Rocky Mountains, you have on the West Coast, you obviously have California, you have the coastline, then you have the Rocky Mountains, and what the Rocky Mountains leads to is the Great Plains. Thank you. Real Safe Title is here. What's up? How are you, my friend? That's why you're getting tote bags. So save you when you go to the grocery store. So you have the Rocky Mountains, and then you have the Great Plains. The environment matters. That's why I'm bringing it up. So off of the Rocky Mountains, something happens. You have the weather, the clouds and everything, and these storms get created within the Rocky Mountains because of the atmosphere. And they come off of the Rocky Mountains and they hit the Great Plains. And when they hit the Great Plains, something happens. And what happens is there's nothing to stop them from continuing the storm. Normally, it would hit whether it's trees or whatever, it would slow the storm down. Well, that doesn't happen in the Great Plains. So these storms are very aggressive. And they come off of it, and it's this crazy aggressive storm that comes off. And anything that's in its path naturally gets impacted, right? So cows are primarily what's in its path. And what happens with cows is they see these storms coming, and they're petrified of the storm. And they run in the opposite direction, and they disperse, and they they don't stay together in packs. They immediately just spread out and run. And what inevitably happens to cows is they're in the storm longer because the storm's coming overhead and it's moving, let's just say, eastward, as are the cows. And so they're getting hit longer and longer with the same storm, and it's worse for them. And they're petrified and running in fear. The opposite approach of a cow is a buffalo. So a buffalo also is being impacted by the same storm, but the difference between cows and buffaloes are buffaloes sprint as a group directly into the storm. And in doing so, they actually stop themselves from getting hit with the storm longer because they're moving in the opposite direction of the storm and it hits them less. That's the difference between cows and buffaloes. So as we sit here and as we approach, let's call it an oncoming storm, and the degree of that storm is yet to be seen because I don't have a crystal ball just like you don't have a crystal ball, but I do know that we're all being impacted right now. So the thought process is you get to choose. You're gonna be one or the other. You're gonna be a cow or you're gonna be a buffalo. You're either gonna approach this storm and you're gonna take it head on and you're gonna figure out ways to survive and to thrive, or you're gonna get hit longer and you're probably gonna fail out of real estate. Because we're gonna get into what that looks like if you decide not to embrace the market and change with the market. And a lot of people do fail out of real estate, and it's just part of it. So I'm not trying to be doom and gloom when I say that, I'm just being real about it. Part one is talking about some headlines. So last time we all got together, I did a whole session about, what's going on in the real estate market, the trend lines and all that other stuff. And there's been a lot of stuff that happened this last few months since our last session during the summer. And what I felt like is, all right, we could glaze over all of that, but I actually think that it makes sense to talk about it because I believe it provides a framework for what we're gonna get into. And the other part about it is, even if you don't, our clients pay attention to headlines. So if you're not educated to the headlines, well, then you're gonna have a problem being educated to speaking to your clients. So we're gonna talk about some real estate headlines that went on and just give you let's just call it context for the market, and that's how we're gonna build from there. So Better lays off thousands more following paycheck glitch. Better is a bank that's, a lender that went out there. They have been laying off people left and right. There's been all sorts of headlines related to that. Better sheds another 3,000 workers. I thought this was interesting to see. They now have 2,900 workers, 72% drop from the 10,000 that they had previously. You think it's pretty safe to say that banks are getting hit right now and lenders are getting hit? I see the lenders nodding their head. First guarantee mortgage, and by the way, this is in, the order is chronological. So if you look at them, it's based on dates. This is June 27th. So first guarantee mortgage cuts 75% of their workforce. The next day, they go and declare bankruptcy. Lenders are getting hit because we had all of these lenders. They went out and they hired all these people like underwriters and everybody on the back end to service loans, and then all the loans just fell off of a cliff. AdWorks, this is a marketing company, they lay off 40 people. Compass is now worth less than they raised from investors. So this is, I don't know what date it is, June 15th. They raised $2 billion. They're worth 1.8. Redfin, the CEO of Redfin, says the market correction is sharper than we expected. It's not one company. Everybody's being impacted by this. Compass loses $101 million. They're no longer offering equity to new agents. So he dropped a bombshell that one of Compass's most effective recruiting tools, the company will no longer offer cash or equity incentives to agents. That's a big deal. And I'm telling you that's a big deal not to knock on Compass. I'm telling you that's a big deal because think of the framework. This is a company that came out, their whole goal is growth. Now they've just pulled the biggest tool that they've had for growth. Like, that doesn't happen on accident. That happens because the market is swinging in the other direction. Compass ditches stock incentives. He explains on a policy call Monday that if a new agent comes to the company with a split that is better than what Compass offers, they're allowed to keep that split for 1 year. After that first year, the agent will then go to Compass's standard splits. I talked about this at the last meeting, and I think some of you guys looked at me and said like, oh, he's probably nuts about this. I'm not nuts. Like, they're pulling back because they're running out of cash. And that's what a lot of companies are doing right now. Loan Depot, accelerating layoffs, exiting the wholesale business. So now they're gone. Wells Fargo reportedly eyeing a major retreat from mortgage. Wells Fargo, think about that. It's one of the biggest names in mortgages, in lending. Look at this. This is from John Burns Real Estate Consulting. I saw this online and I had to steal it. So when rates shift, this is something that you have to understand. And by the way, this is a little bit older, meaning 3 or 4 weeks older. So rates then went back down. They were pulling back down for a few weeks there. You could probably speak better at this, but it went from let's call it the mid 5s and it dropped down into the 4s, please.
You're giving us the bad news first, right?
Yes. I'm glad you said that because I'm going to touch upon it. This is really funny that you said that. So years ago, and I'm going to talk about my real estate sales career, but when I was in the midst of hell raining fire, essentially, in the marketplace, and what I realized back then is one of my taglines was, I'm not going to tell you what you want to hear, I'm going to tell you what you need to hear to make smart decisions, because people need to hear the facts. So I'm not going to sit up here and tell you bullshit. I'm going to tell you what's really going on, and so you can make smart decisions for your business. And it's not doom and gloom. This is reality. We're all grown-ups. We're all going to face good markets, bad markets. There's no such thing. I hate even saying it that way. It's not a good market and a bad market. There are challenges in every single market we deal with. I mean, how hard was it a couple years ago when we were dealing with the challenge of no inventory, or even a year ago? There was nothing to sell anybody. People were pulling their hair out. I have all these buyers, I got nothing to sell them. Every market has a challenge. Every level has a new devil. We always talk about that. And this market has challenges just like the other markets. And I actually think this market has just as many opportunities, if not more, which is what we're going to talk about. So when rates go down, which is what this chart is showing, more people are able to afford to buy houses. It opens up the buyer pool. Rates just skyrocketed. What does it do? The reverse. Naturally, it's going to have an impact on pulling more people out of the market, which impacts demand. So that's why I'm showing you this. More Compass layoffs. Compass by the way, I'm not zooming in on Compass, just to be clear. I'm literally pulling, I don't know what they did in their PR department, but they really screwed up this summer because they were getting absolutely murdered in the headlines. Compass revises market share. So I thought this was really interesting. You know how Compass came out with all this stuff about #1 in the country and all this other stuff? Well, then they came out with a retraction saying that they screwed up the math. Keller Williams cuts jobs as Austin market cools. So it's impacting everybody, like I said. It also is impacting us, which I'll talk about. 4th round of layoffs as Keller Williams heads into mega camp. 2 Compass execs sell $1 million worth of their shares. They were selling their shares for pennies on the dollar. Gary Keller, the current market is the most confusing I've ever seen. So think about this. You have the CEO of Redfin, like Kelman. You have the CEO of Keller Williams. They're all saying this is the craziest market we've ever seen in terms of a pullback. Like that's a pretty big indication of what's going on right now. Compass fires their CTO. They're laying off tech employees. Their workforce, they cut by 10%. Really, which is basically like one of these hybrid models that came out, just closed their doors because they couldn't exist in today's world. They couldn't compete. Anywhere, this is us for those who don't realize it. So Anywhere is our parent company. Anywhere just slashes staff. So I've gotten asked a number of questions about what does this look like in terms of what are we doing? Because we're not immune. Everybody's getting hit by what's going on in the marketplace. When the market drops off by 30, 40%, like something's gonna change. So in our case, the way that they approached us from an employee perspective was pretty simply that we're gonna do everything in our power to try to make expense cuts, because we all have to make expense cuts. We're gonna try to do everything in our power to cut expenses without hurting agents directly. So what does that actually look like? I'm gonna give you 3 different examples, one of which you might be aware of, 2 of which you might be aware of, but one of them you probably don't. So one example is, remember how we changed, I put out a message to everybody about MLS fees? So for years, we were taking a loss on MLS fees. And the thought process was, that's not helping any of you, that's just hurting us. It's essentially helping our competitors in the marketplace. So we made that shift and said, you know what? We're going to be in keeping with the market in terms of MLS fees, and we're no longer going to take that hit because it saves, over the course of every single person in the marketplace, it saves so much money for us that it keeps us whole in terms of saving jobs. I thought that was a very smart way of approaching this. Another thing that we did, you guys may have heard, I don't think anybody's in here from that office, but we closed our union office. So when you look at across New Jersey, and this is not a knock to the union agents or to that office at all, but it is a business. And we have to look at the numbers and say, like, what locations make sense to stay open? What locations make sense to go away? Well, when we looked at union, it actually made a whole lot of sense to exit that market. And here's the reason why. It's not a shot at union as a town or the agents in particular. When we looked at it, 85% of the business that we were doing in union was being done by offices not in union. So the Maplewood office, our Short Hills office, our Summit office, our Westfield office, if 85% of the market share being done in a town is not being done by the office that's in that town, we're probably in the wrong town. Like, that's the truth of it. So it made complete sense for us to scale that back. By the way, food's coming, so I hope you guys are hungry. It made complete sense for us to scale that back, and that's one of the things we did. Look at this army we have. I like it. Thank you, guys. So we did that. Another thing that we did is they let go of a regional vice president. And it was something that they decided that they wanted to restructure the way that they were doing the regions. And they let go of an RVP. Sorry. And the thought process is, okay, if we let go of this RVP, it saves us from cutting back on marketing staff or cutting back on, services for the agents. It's not personal, it just is what it is. It made sense to do that, but that reaction, everything that gets done in a marketplace, we got to try to figure out how to pick up the slack. So one of the things that changed for me personally is, for years, I've been a district vice president where I've been overseeing Short Hills, Maplewood, and Summit, and they basically switched my role. So now I'm overseeing Maplewood specifically, but I'm also overseeing a region. So I have all of Essex County and Summit. And I have some of the managers that I get the pleasure of working with in this room right now. And the truth of it is I'm excited about the role for a number of different reasons. One, from a macro perspective, it gives me a little bit more insight. But beyond that, one of the asks that I had was, I said, listen, I'm willing to take this role on, and this is something that I'd be open to, but it can't be at the expense of Maplewood. It can't be at the expense of anybody that we serve. I want to be able to provide more service, not less. And the counter to that was, I need more help. I need more people, like from a staffing perspective, to be able to help with some of the training that we're doing and all of that. So the exchanges, in the next couple of weeks, this is happening, we're actually going to pick up, I don't know if you guys remember Sarah Whitner. So that position is called an ADS. So one of the things that I was fighting for is, not fighting, I don't want to say it that way, but I was pushing for is, hey, listen, I need more ADS support, and I don't want to have to go to somebody for permission for that ADS support. I want to just have it regularly where we could constantly use it and be able to leverage it how we see it appropriate. So what we're doing is every region, in our case it's called a district, is getting multiple ADSs that we're going to be able to use, in my case, with the 6 offices that we have. So I just want you to know, like, it's not cuts for the sake of cuts. It's intelligent cuts to try to add more value while still being viable in a new world. So if you have any questions about that, come see me, but I just wanted to give you an insight on what we're doing behind the scenes. That was by the way, I talked about this before. We're not lowering splits. This is from the last meeting I did. You know, consolidation. I kind of had an idea of where we were going with this, and now it's becoming a reality. So it impacted Zillow. Shorting Zillow is the best bet in the housing this year. Look at Zillow's stock. Zillow's stock has been like, basically parachuting down for some time now. Why? Pretty simple, because agents, when they're making less money and business is down, they're spending less. That's just the way they do it. Now, there was something in this article that I thought that was really important for you guys to hear. I'm going to read through some of this. Hold on one second. Forget about that. This is what I wanted to show you. 234 million people surf Zillow's apps and sites monthly. It's equivalent to 90% of the United States adults. But Zillow monetizes only 3% of that. So to me, that was like a statistic that I was like, whoa. Zillow's whole mission in life right now is to figure out how to make money on these amount of people. That's their whole mission in life. So that's going to be title, that's going to be mortgage, that's going to be insurance, that's going to be trying to pick up buyers, that's going to be trying to sell you leads. There's a million different ways they're going to do that. But there are 2 takeaways that I had on this specific issue is, one, whoa, that's a big number in terms of how many people go through Zillow. And the second thing is as much money as Zillow throws at this problem, they're only picking up 3% of leads. 3% they're able to actually make money off of. So it's still a big number relative to the total. But when we think of internet leads, like that's what we're talking about. Zillow, with the infinite amounts of funds that they're throwing at it, only closed 3%. You have to think about it that way when you're approaching internet leads. It's a numbers game. You got to get in front of a lot of people, otherwise it's not going to work. I'm going to get rolling again because I want to be respectful of your time. We all good with lunch now? All right, good. Sorry about the delay. So, pick up where I left off. We're just going to keep going chronologically with some headlines. So if you look at, I don't know if you ever saw this, but if nothing else, I just wanted to put it on your radar. Realtor.com comes out with weekly housing trends. So all you have to do is like go on Google and go Realtor.com weekly housing trends. So it's very simple to find. Hello there, welcome. So it'll show you, like, this is national, but it'll show you median list price, new listings, actives, days on market. Just like an interesting kind of pulse of the market across the country if you want to get one. Compass is the world's most unprofitable brokerage ever. Thought that was a cool headline. I cracked up over that one. So this is actually, we're going to get into some, the next step of where we're going with this. The Fed's seen sticking to interest rate hikes even as unemployment rises. So this is September 2nd. The Fed, even though we're seeing unemployment, go in the direction that they want it to go and everything else, inflation is not where they want it to be. So they're still sticking to hikes. It's a big deal, you got to understand. Like, they're not pulling back on that. If anything, they're moving it forward. And for that reason, banks are responding in kind. Like, naturally, the Fed controls the discount rate, but banks are upping their rates as well. So if you look at like where rates are today compared to where they were, a year ago, rates were at 2.93. They're up 3.09%. So they're at 6.2%. And I realize that this fluctuates day to day and bank to bank, I get that. But like, I just saw that and I was like, whoa. I mean, they're more than double what they were a year ago from today. You don't think that's gonna have an impact on the market? So Robert asked me a good question during the break. He said, is this just like all of, a reflection on rates? Well, a lot of it is. I mean, they just basically threw a wet blanket on top of the real estate market. And the crazy thing is, when you think of the economy, a lot of times, things happen in the economy and they don't necessarily impact real estate. Well, this is one where we saw inflation go so high that the number one thing it impacted was real estate, because they just threw, rates, they jacked up rates, I should say, so high that it's like, it's making the buying power so much different than it once was. I mean, when rates go like this and just shoot up, we saw a couple months where they started to come down a little bit, and now it's right back up again. So this is a zoomed out version from 2010 until today. This is from 18 until today, and then this is like right now, like the past, this is from 1971, so this is everything. Why I brought this up is, we've seen rates this high before, but we had to go back to 1981. So, I mean, rates, and they're not, and I shouldn't say it that way, that's not true. We've seen rates this high for many years in between there. But more recently, since like 05, let's call it, even before then, we've seen rates lower than where they are today. So this whole buying population right now has either refied to a lower rate, like in the house that they live in, or they're looking at it for years saying like, whoa, I could afford so much more than I could afford today. That's gonna have a ripple impact on the market. Like, there's gonna have an effect, there's no question. So, I don't know why this happens, it's so annoying. I gotta get a new clicker. So, a couple more slides on headlines, and then we're gonna shift over to the next section. SoftBank loses. I'm telling you, their PR department is terrible. So I literally went day by day through every headline, and it was like, Compass gets crushed, Compass loses their shirt, Compass is losing, is on fire. So, I mean, that was essentially what this was. But I did want to bring this up because I thought this was interesting. Compass went public on April Fool's Day, selling 25 million shares, $18 a share. After the IPO, the company was valued at just shy of $7 billion. Its opening day price was $20 a share. It's dropped 86% since then. It's now worth $1.21 billion. It's a pretty crazy drop. That's real estate market related, and I know this seems like I'm drilling them, but I'm saying this on purpose because they threw so much money at the problem. If the real estate market had gone up by 10% a year steadily, they would be in really good shape. But they went out and they bought people at the height of the market, then the market crashed, and it's killing them right now. So it's, some of it is artificial. The company disclosed losses of $289 million in the first 6 months of the year, and it's looking to slash its costs by $320 million because it's trying to get profitable. That's why they're cutting their technology. They're doing all sorts of things to get there. This is more reflective of the real estate market as a whole, is why I'm bringing this up, because Compass is clearly getting killed right now, but when you look at like what they did, they tried to go out, a lot of companies did this, they tried to go out and buy people, they tried to figure out market share artificially, and they're getting hurt because the market's now doing what the market does, it's turning. So when you go out and you see agents, because this is something that has been brought to my attention a lot, you see agents like every month they're in Matters magazine, and they don't do the production to support it. Or you see them online constantly pushing out ads. Like, some of that's artificial, and it's gonna come back to hurt them if the market continues in this direction, which is all the more reason why I'm trying to impress upon you guys, and I know this has been a lot of doom and gloom, but I promise it's not gonna be all that. I want you guys to be smart about how you structure your business, because most companies can't sustain the losses that they're sustaining right now. Most individual salespeople can't sustain those losses. It's a really difficult thing to do. You have to be intelligent about how you approach marketing and how you build your business in a shifting market, because it's definitely shifting, and if you're not paying attention to it, you're gonna get hurt. Real estate stocks are getting absolutely destroyed right now. That was the headline from yesterday. So, all this is like, kind of heavy with like the sky is falling. I understand that, but it's not falling. And part two, and where I'm going with this, is to talk about like, are we in a storm? Like, it clearly appears that way, but headlines don't necessarily tell the whole story, because headlines are trying to sell papers. They're trying to create this like sense of, urgency to like read this. So does that tell the whole story? Maybe, maybe not. Let's talk about that. Like, is a recession around the corner? So this is from the Wall Street Journal. Most economists are saying yes. I mean, now 49%. So that's high enough for me. Like, most people are thinking that we're trending towards recession. I'm not like screaming about recession. Like, it's not scary to me. Like, but then again, I'm also not a cow. Like, I'm not somebody who's like, oh my God, like, the real estate market's changing and I need to run in the opposite direction. So I want to give you a lot of times people like think like, well, how impactful was a down market on realtors? Like, because you guys are all real estate agents in this, or brokers, like in this room. So what impact did it have on people in the industry? So if you look at the National Association of Realtor members, this is from 1908 to today. So you could see it's a pretty upward trending graph of how many members, how many people have a real estate license or getting into real estate. The previous peak prior to the last couple of years was in 2006, 1.3 and change realtors, million across the country. It dropped down to 999. Like, so if you think about like that's from the peak in 2006 to 2012, a total drop, 1 in 4 agents left the business. 1 in 4. So 25% of this crowd, although not this crowd, but 25% of agents in general left the business. That's a big number. It's a really big number. I mean, that's the way you have to think about this. That's how impactful those years were on people's businesses. Now, for the people that survived those years, well, great. It became a lot easier when you didn't have 25% competition is gone now. So that certainly impacted, people for the positive as well. Then it rose. Look at the years from this, from 2000, I think it was, what year was it? 12. From 2012 until now, because they don't have this year's numbers yet, 1.5 million, 64% increase. It's a lot of people that came into real estate in the last several years. I guarantee you they're not all going to stay in real estate. I can guarantee you that. And if you think about it, one of the biggest reasons why they're not going to stay in real estate is, why did they come in real estate to begin with? A lot of these people came into real estate because of COVID. They were like, oh, well, I'm working from home. Like, I could go out and get a real estate license, and it's, I'm going to learn the business while I work from home and all this other stuff. Now, some of those people are going to remain. Some of those people are in this room, thankfully. But like, not everybody will. People are going to leave this business. There's no question about it. Part of this is like, how do we figure out how not to be part of that group? In New Jersey, you could see there's the same bend. Previous peak, 58,000 agents in 2006, dropped to 41,000. That's 30% less in New Jersey specifically. Rose back up to 61,000. That's a 48% increase during that time. The real estate market ebbs and flows, so does agent count. Keep that in the back of your mind when you're thinking about, competition. Like, everybody and their mother has a real estate license right now. Well, that's not going to be the case a few years from now, guaranteed. Does this mean we hit the panic button? No. And in order to prove this point to you, I want to flash back. The year was 2005. So back in 2005, this was the build up to 2005. These are new home sales, and recessions are the blue area. These are home sales from 1963 and up, like all the way to 2005. It's a pretty good real estate market. It was growing and building, and life was good, sunshine and roses. So this dope that I know decided to get into real estate. So this was me from 2005. So I got into real estate. It was actually 2006 that I got in. And from the minute I got into real estate, quickly thereafter, this happened. It was like literally a just straight dive down. And the crazy part is, this subsection that I'm showing you here was my sales career. Quite literally. Like this, I got into sales in 2006. I came here in 2012. So that was my entire sales career, and it was a free fall off of a cliff in terms of the market. Now, I tell you this because I gotta be honest with you. That's how I learned real estate. I learned real estate in the worst real estate market in the history of time, minus the Great Depression. So certainly in the history of our lifetime, that was where I had to learn how to survive. And I remember, some of you guys in this room remember these, when Lehman Brothers and Merrill Lynch and AIG, like these was the headlines, Wall Street was getting crushed. And I was working in Summit, which is a Wall Street driven market. So it was not a fun time to be in real estate. I walked into the office one day, and I remember when AIG got bailed out, but Lehman, went under, I walked into the office, 20 computers in the office, all 20 people were on monster.com looking for jobs. All 20 people. Like, you can't get 20 people to do anything. Like, I mean, the reality is like, it was doom and gloom. Like, and the crazy part is like, you couldn't even get a job. Like, the economy was so bad at that time that it was like, you're in real estate, you might as well stick with it. Like, and I could tell you, and I'm not trying to scare you with this, but like, it was hard. It was hard. It was hard. Anybody who is in real estate knows it was hard. It was really, really hard. Like, and there's a nice twist to this. Like, I also grew my market share during that time. Like, I doubled my business and doubled my business and doubled my business to the point that they were crazy enough to give me a job in management. So the reality is like, it doesn't mean that just because the market's going this way, it doesn't mean your business is going this way. It does mean that you have to change the way you focus on the business. You have to, because you can't use the same techniques in that market that you use in the market that we just had. Like, it's just two different skill sets. So we're going to talk about that, but one of the things, I saw this quote and it really struck me, like, in the context of this, and it said, no one would have crossed the ocean if they had the ability to get off the ship in the storm. Like, if you're in the middle of a storm, you're like, please save me. Like, but it doesn't mean that there's not new lands on the other side of it. And that's where I believe we're trending. I don't think that we're certainly not going to see what we saw, and I don't have a crystal ball just like you don't, but I don't think we're going to see what we saw in 2006 and into 2007, 8, like, no way. I mean, that was once in a lifetime for most of us. So I don't think we're seeing that at all, and I feel better as a manager. I think about this, like, I've been managing a real estate office for, call it 10, 11 years in a marketplace that's pretty much gone like this, which is not my skill set as much as a market that's going like this, because this is how I learned real estate. So I'm feeling great about what we're coming into, as crazy as that sounds, because it's what I know. It's how I know how to survive, and I want to teach you guys a couple of those lessons as well. So part 3, forget about the cows for a second, let's talk about being a buffalo. People are scared. When the market turns, some of you are scared, but your clients get scared too. Maybe not yet, but it's coming. And I'm going to tell you, buyers are scared at interest rates right now. That's a different type of scary, because it just causes them to delay. Sometimes. It doesn't mean that they're like never going to buy a house. That's not what I mean. What's scary is when you think your house is worth $500,000 and it's worth $400,000. That's really scary. That's when people freak out. And when people get scared, you have to be the voice of reason in their world. You have to be. In times of uncertainty, people follow the certain. That's the truth of it. If you are not the rock for them, you're screwed. Because you're never going to get the piece of business. And there are things that you need to do to put yourself in the position to be that rock. And that's where we're going with this. So it starts with expertise. I can't stress this enough. Like, this is the start of where I'm going, but it's, I could talk about this for 20 slides because it's so important. So think about the world of real estate. Real estate is everywhere. You go to any cocktail party in time and they talk about houses and what's going on in their home and all that stuff. That's just normal course of life. People move for all different reasons. People move because, they're having a baby, because they're getting divorced, because they're relocating, because they're, the million things, moving up, moving down, like retiring. life reasons force people to make moves. But the headlines are what they constantly are seeing. And in good times, like, in the last few years, all you hear is the real estate market's on fire. It's an amazing time to be in real estate, blah, 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 all of that. Well, what do they, they internalize that as, oh, it's a good time to sell my house. It's a good time to buy a house. It's the worst time to buy a house, but they don't view it that way because they're reading the headlines and they're hearing how wonderful the real estate market is. They're thinking, let me get in on this. Like, it's kind of like when Bitcoin is on fire. People are like, oh, I got to buy Bitcoin. Well, now it's like in the tank. Nobody wants to buy it. Like, that's the way that the world works, is they get moved by headlines. So if you're not cognizant of headlines, you're putting yourself in a bad position. But here's the thing. We can't get lost in the headlines because you got to be above that. You have to be the ones that are, again, the voice of reason, of certainty. When you're at a cocktail party, when you're on social media, when you're sitting at the listing table and you're having conversations with them, you need to be equipped to get past the objections of the headlines, which is not easy to do. And that's where I'm going to focus this. So first of all, you have to be an awesome storyteller because the Wall Street Journal tells a pretty good story. The New York Times tells a good story. All of these entities are telling them over and over and over again about how the market, recession, and all this other crap that's happening, like interest rates, inflation, they're just beating people over the head with that. They just naturally, people suck into their shell and they're like, I don't know if I want to make a decision because indecision is better in times of uncertainty for a lot of people. So how do we get past that? We got to be a really good storyteller, but it's really tough to tell a story the correct way unless you know all the characters and the perspectives and the way to actually tell that story. So you have to start with the market. Don't get caught up in the headlines. And I bet you I'm going to show you something that will surprise you in what I'm about to go through. So when we talk about the market, you have to be the smartest person in the room when it comes to the market. You have to be. And if you're not, you're at a disadvantage. And you want to talk about one of the biggest advantages that I had in sales? I knew the market like the back of my hand. Like the back of my hand. I knew I could tell you what was trading, what it was trading for, how much it would be. I knew the curve line in terms of what was happening in the marketplace. I knew that if you based your price off of last month's numbers, you were going to have a problem because the market was dropping at about 5 to 6% a month and all that other stuff. I could speak to that. And I wasn't afraid to tell a seller straight up what they needed to hear. God bless you, I think. So you have to be able to speak that language. So we're gonna have a little fun real quick. We're gonna just do a pop quiz. Shout them out if you know the answer. Number one, what are the two primary forces that drive a market? Supply and demand. Thank you. So supply and demand, most people will know that, supply and demand. Any market's being driven off of supply and demand. So for those of you who don't know what this chart is, I was an economics major, so I'm gonna get a little nerdy for a second. But basically when supply pulls back, there's less supply. Equilibrium is where supply and demand meet. So you're always looking for the X. So if this line pulls back and there's less supply, it's gonna meet further up the demand curve, which means that the price is gonna go up. The reverse is also true. If there's more and more supply, it's going to go further to the demand curve, and naturally the equilibrium on price is going to be lower. Simple supply and demand thought process, in terms of how to read this. So a lot of people understand supply and demand, whether they understand the chart or not, they understand how it works. And most people realize it in this context: rising supply, declining demand, prices go down. Falling supply, increasing demand, rising prices. Pretty basic. Every one of your sellers, with little exception, is going to understand this. So if you start talking to a seller and you're like, it's demand right now, one, red flag, because they're going to be like, there's no buyers in the marketplace, is how they're going to interpret it. Maybe that's true, maybe that's not, although I'm going to show you how it's not. But the truth of it is how you say some of these things will resonate with them, depending on who you're sitting in front of, more so or less so. We're going to dig one step further on this. So you have supply and demand. Everybody understands what supply is. The second question is this: what's the difference between supply and inventory? Any takers?
Supply is what's coming in, inventory is what's the whole.
So pretty much, I'm gonna say it a little differently, but supply is the total amount of homes that are on a market in a given time frame. Inventory is what's on the market right now, like the total amount that's on right this second. So the number of homes to enter the market in a given period, the number of homes currently on the market, they're not the same thing. And I'm gonna show you that there's a big difference between those two things. And before I get into the next slide, I want you to think about it this way. You could have really low inventory. We do have really low inventory. And you could also have really low supply. So how does that happen? Well, if houses are still selling at a pretty good pace, but inventory isn't coming on, well, that means that we're having a supply side issue in that instance. We don't have enough supply coming on the market, and prices could still go up because that's one of the things that we're dealing with in today's market. Like for the past year at least, we had low inventory, we had low supply. The reverse could be true. All the tweak that needs to happen is days on market. If days on market continues to go less or higher, it's going to tweak that ratio. So they're two different things, and they present different challenges depending on the marketplace. Number 3. Our market is shifting. This is the reason. And I want to go through all of these, and I just want you to raise your hand if you think that this is the reason why our market's shifting. All right? So there's no right or wrong answer. This is an opinion. A, lack of demand. We got 3 people on demand. B, lack of supply. We got a little bit here, maybe 6 to 10 on supply. C, falling prices. Nobody. D, rising prices. Half the group. Inventory issues. Interesting. So I would say more people went for inventory issues than anything. A was the worst in terms of the amount of people that raised their hand, and everybody else is in between. So we're going to do a case study, and I'm going to specifically talk about Maplewood. This was mind-blowing to me, and I think you guys are going to find this to be really interesting. So I wanted to throw COVID out of this. I looked at the Maplewood market from 2013 to 2019. So as the years building up, I couldn't go beyond 2013 because they just don't give you the numbers. So from 2013 to 2019, I looked at all the closed sales, all the new listings. You don't have to worry about these numbers because I'm going to make it really easy. This is the average. So the annual average, there were 335 homes that sold. This is on the MLS, obviously. There were 335 homes that sold in Maplewood on average during that time frame every single year. There were 417 houses that came to market. Roughly speaking, that's supply and demand. Like, very simple. If you look at the years, and by the way, I'm going to just make a note on 2022. We're not through 2022. All I did was just double the first 6 months, just to try to get a rough idea. I know that's not a perfect science, but give me a little leniency on that. So 2020, 2021, keep in mind, 335 went up to 356. 2021 went up to 367. It's down to 264. It's a pretty big drop, right? Sold homes are 28% below what they were last year. That's on the MLS. 28% less sales in Maplewood than 1 year ago. That's scary. New listings, 4%. So supply is relatively the same. But the amount of demand, the amount of sold homes is significantly less. That impacts all of your bottom line. Now, you could freak out over that, or give you a little bit more context. Let's look at, all right, that's year over year. Well, we know 2021 was a crazy good year. So what about versus the average? Well, the average sold homes were 20% below the average, 7% new listings. It's pretty extreme. That's over the average prior to COVID. Now, again, you could look at this and you could freak out and be like, whoa, the market's shifting heavily. But I want you to just change the way you think about this for a second, because this is not the way I view this. I took it one step further. So this goes back to my real estate career. You got to look at the market differently. When the market's shifting, you got to kind of view different ways to position it and tell the right story. So here's the story that I would tell. Change the way you look at things, the things you look at change. COVID happened. We all know that. It's obvious. The whole world knows it. It's every headline everywhere and every crevice in the whole entire universe. So we can't ignore it. we have to just say like, all right, like that changed things. How did it change things? Well, what if we took the last 3 years and we made them 1 year? And I know that might sound weird, but it's an easy way to do it. You just find the average of those 3 years. So the average of those 3 years averages to 329, 408. 335, 417 was the annual average prior to COVID. 329, 408, 335, 417. We're within 2% on sold homes. We're within 2% of listings. Of the annual average prior to COVID, if you take those 3 years and put them together and average them out. So what does that mean? Like, it actually tells a really interesting story. The interesting story is the transactions were front-loaded. The market is just normalizing back to that average. So it's insane for us to think of every year we're gonna sell 400 houses in Maplewood. No, the average of homes that sell in Maplewood are 335. Consistently for years and years and years. Now think about this on a very practical level. Like, practically speaking, what does that really mean? That means that a seller decided it's time for me to sell my house, and a buyer decided I want to buy it. Like, those two things have to happen. So for us to just universally think, well, COVID happened, so now it's automatic that there's going to be an extra 70 people every year that are going to want to sell in Maplewood. Why? Why would we think that? It's, there's still the same life trends. There's still divorce, there's still marriage, there's still, moving up, moving down. None of those factors have changed. The only thing that has changed is that a lot of people decided to sell and a lot of people decided to buy as a reaction to COVID. Like, that's normal. It makes sense. People were fleeing the city. Like, people were deciding, hey, I could sell my house because I could work from anywhere. There's a lot of different reasons why that happened. So now we're seeing this shift. Like, all it is us getting back to normal. Like, which means that the expectation moving forward, I don't know if we're gonna hit it or not. Maybe we do better than that, maybe we do worse, I have no idea. But the expectation should be this. You should expect that there's 335 sold homes to sell in Maplewood next year. It's gonna resort back to the average eventually. The question is when. And now, I will tell you, if you look at the years before COVID, some years it was 10% higher, some years it was 15% lower. I understand that there's gonna be some movement from year to year, but just like if you think about it, you could have a kid in class and one class has 28 kids in the class and your other kid could have 20 kids. Well, naturally, like, different grades have different amount of people in them. So you're gonna have different movement just on that. Like, there's different amount of children involved in the scenario. There's a lot of reasons why from year to year the numbers change. But the point is like, this doesn't make me freak out. This makes me realize, like, this should be happening. It would be really weird if it continued to go at a higher rate. Like, why? What changed? Like, this makes way more sense. So when you're telling a story at a cocktail party, and you're sitting there at the listing table, and you're sitting there, when you're pushing out stuff on social media, it shouldn't be doom and gloom. It shouldn't be like, oh my God, the market's 28% off. No, the market was front-loaded in 2020 and 2021, and it's normalizing. Doesn't that sound a lot better of a story? Because it's true. It's not a story that's like false. It's not a false narrative. It's the truth. So when you look at the market differently and you start to think about how to position it, it makes you sound way more intelligent because everybody else is saying, oh, the market's dying and everything else because they're reading headlines and you're like, wait a minute. Like, it's a simple way to portray it. What about price? This is mind-blowing. I'm serious when I tell you about price. And I'm using Maplewood as the example, but it's true in other markets. This is what happened in pricing in Maplewood. This is the median price. So it's throwing out outliers. In Maplewood in 2013, the median price was $500,000. This year it's $921. $921 is the median price in Maplewood, New Jersey. That is insane. Now, I didn't do this because I don't want to make it seem too extreme. But I am going to show you inventory and a couple other things. But I want you to think about this. The jump from 755 last year to 921 matched with a doubling of interest rates. Think about how impactful that is on somebody's monthly payment. It's insanity. Do you think that the market's not going to pull back? Of course the market's going to pull back. I mean, it's just logic. Like, there's way too much built into that in terms of added expense. So we're going to talk about that in 1 second, but it just gives you an idea of how much Maplewood has risen. And other towns have done the same. So this is not just Maplewood. What about inventory? Inventory is not a lot of people raise their hand. Most inventory got the most responses. Inventory is not the problem. It's not a lack of inventory right now. It's been pretty consistent. Like, it goes up and down every year, but the reality is last year inventory was a problem. We had 13 houses on average, on the market at a given time. Like, we're up to 37 in Maplewood. It's not, crazy low compared to, other markets that we've had. It's not super high either, but it's not our problem. A lot of people think inventory is the problem. It was a year ago. So the questions you got to start asking is supply lacking? Is demand lacking? Are prices failing or falling? Are units down? Are we having inventory issues? You have to look at the market through different lenses. No is the answer on supply. Yes is the answer on demand. Prices, no, not yet. Units down, yes. Inventory, no. That's the answers right now if you look at the actual facts. We have a demand side issue, and it's being driven off of interest rates, and it's being driven off of price. That's our issue right now, period. So we talk about interest rates doubling year over year. I want you to see what this actually looks like, because ultimately, this is the conversation your buyers really care about, and this is the conversation that it's going to impact sellers if it continues. So if you take and all I did was take the median sales price. I did it from a year ago, $755. Interest rates were at 2.93. Put down 20%, your monthly payment is $2,500. 1 year later, same exact terms, everything is the same with the exception of interest rates. Interest rates now, this thing froze. Interest rates now jumped up. Interest rates jumped from where they were. They jumped from where they were, now they're at 6.02. Big jump. Look at the difference in price. A difference of $1,100 a month. That's a lot of money. It's a lot of money for the average person. $13,000 a year difference on your median sales price in Maplewood right now. Most people, if you think about it, I don't know how much it costs off the top of my head, but I guarantee you, to join the Maplewood Country Club is probably somewhere in that range, depending on what your age group is. It's expensive to go out and spend an extra $13,000 a year. It's not cheap. Over the life of the loan, it's almost $400,000. Now, most people will never get to this, and you have to really drill them on that, because when you're talking about it, you got to get them to understand that, hey, listen, you marry the house, you date the rate. You've been hearing all the internet saying that. That's the truth of it. Interest rates are going to fall. It's just they're not going to fall yet. And we'll talk about what that looks like in a second. So this is all driven off of the Fed. This is all driven off of inflation. That is what's driving all of this right now. No question about it. That's what's driving the marketplace or hurting the market. So I was going to do a break right now. Do you want me to keep going? Or do you want to do a break?
Keep going.
All right, keep going. So we're going to jump into part 4. So part 4 is a recession around the corner? I just talked to you about this. Most people are saying that, yes, we're seeing a recession. So how does a recession impact price? I guarantee you that this is something that you're not going to expect. When you think about recessions, the first thing that goes through everybody's mind, and think about a buyer for a second. They're reading all these headlines, all this crap about recession. What are they thinking? Well, I'm going to wait because prices are going to be less expensive next year. Oh, really? In the last 6 recessions, 4 of them prices went up. 4 of them out of 6. There's only been 2 times in the last 6 recessions that prices went down. Now, one of them was the Great Recession, where it was a mess on so many different levels. And the thing about this particular recession, you have to understand, there was a lending crisis. That was the biggest driving force, at that particular time, is people couldn't get a mortgage. So many banks were going out of business. I'm sorry, I'm in your way right now. So many banks were going out of business and everything else. That to me is such an awesome thing to speak to a buyer about. Like, hey, let me show you something real quick, and just put this in front of them. Like, you really think that a recession is gonna solve your problems? I don't think so.
Wasn't 91 the savings and loan crisis?
I believe so. I don't remember off the top of my head.
2 out of 2.
2 out of 2, that's fair. That's a good point. So 4 out of 6 home prices increased. It's a pretty good stat for you to bring up. And one of the things that I'm gonna show you is like, it's not just, talking this, it's also putting it out there into the universe, social media. Like, put out there that like, hey, yeah, we're hearing signs about recession, but did you realize that out of the last 6 recessions, 4 of them had increasing home prices? It's a pretty good message to put into the marketplace. So this is just like an example of something you could put out there on social media. Hearing talk about a potential recession, wondering what that means for the housing market, know that an economic slowdown does not equal a housing crisis. In 4 of the last 6 US recessions, home prices actually increased. DM me so we could talk about your housing needs and goals in today's market. It's a pretty good message to put out there. You should think about doing things like this. A recession means more in terms of falling mortgage rates. So when you look at recessions, every one of those recessions came attached to a drop in interest rates. Why? It makes perfect sense. When GDP goes down, there's less people buying goods and services. Like, naturally, the Fed has to do the reverse of what they're doing right now. They have to say, like, all right, like, we know that we have to speed the economy up. How do we speed the economy up? We lower interest rates. They're going to lower interest rates as soon as the economy slows down. That's what they're doing. That's the whole goal here. So don't get blown away by headlines. I know we started this with a lot of doom and gloom. I did that intentionally because it was a setup. I want you to realize that, you know what? Like, there's a lot of that. All your buyers, all your sellers are hearing about all that nonsense, but it's not the right story. The right story is this is an artificial thing to try to slow down the economy. And it, just like why I say it's artificial, it's going to get reversed. That's what's going to happen. Marry the house, date the rate. That's the whole thought process. So in terms of what rates actually dropped during this recession, they dropped from 16 to 11, 18 to 13, 11 to 8, 7 to 6, 6 to 4, 3 to 2. They always drop. Like, it's part of what goes along with a recession. So just get that narrative in your brain when you're talking to a buyer. How does a recession impact price? So we talked about that, but I want to take it a step further because it's really, it's cute that you put up a slide about like, well, yeah, like, in the last 4 recessions or last 6 recessions, 4 of them had increasing prices. But what about this recession? Why is this going to be different than, 2008? Because that's the next question, the setup question that you're going to get. So the answer to that, in my opinion, is a lot of different variables, and I want to show you some of them so you have some talking points to bring up why this is different. Well, for starters, supply of homes, way down. So we talked about what are the 2 driving forces that drive a marketplace, supply and demand. Well, supply is way down compared to where it was. It's nowhere close to those numbers. This is 2007, 8, 9, 10. Look at where supply was, look at where it is now. It's below the average. So one side of the, in terms of the 2 forces, one side is working to the advantage of sellers. Month supply of inventory, way into, if you want to look at it from a rate of absorption perspective. Sellers market, I usually say 5 months or less. Let's call it 6 months or less for the purpose of this. That means that there are less options on the market than there are buyers. Naturally, that's going to cause prices to continue to rise. Well, right now, that's where we are. We're still super low in terms of rate of absorption. Single family housing, this is a crazy thing. For the last 14 years, we are below the 50-year average for houses being actually built. Nobody's building housing right now. And the housing that they're building $2 million, $3 million, $4 million houses. Why? Because construction materials are so expensive today compared to what they were. And it's so expensive to get a piece of land that the combination of those 2 things is driving up the cost of actually building. So they're only building things that they can make money on. So that's what they're building right now. We don't have enough inventory. I read somewhere, it's not in this slide, but I read somewhere that we're, I think, 5 million units short, according to NAR, of construction. We have a deficit of 5 million houses across the country that we need in order to get back to a normal, market. That's a lot. US population, I love this one, and if you're not paying attention to this, you should. So when you look at like the populations of people, baby boomers were the largest population of people. Not anymore, millennials are, and look where they are. They're in their home buying years, between the ages of 20 and 34. So think about this, supply and demand, two forces. We have very limited supply. We have the largest population in the history of the United States that's coming into their buying prime. Doesn't that represent demand? Because I don't know what else represents demand better than that. Like, and if you look at the drop off, so think about like right in here when this dropped off, well, those were the years that we had a recession because we didn't have demand. We didn't have the demand in the marketplace because there wasn't the population to support the demand. It's such an easy thing to show somebody to say, hey, you really think it makes sense that demand is going to go down? Why would you say that? What would make you think that? Are all of this population of people going to rent forever? No. Like eventually they're going to buy. Like everybody decides to buy. Most people decide to buy at some point in their life. Like this to me tells the whole story that you need to know as a buyer. Demand is coming, and it's coming in a giant wave. 3 reasons to buy a home right now. Simple things like month supply of inventory is rising, which means that sellers feel a little bit more vulnerable. Amount of offers on a property has been decreasing month after month, less competition. And then there's fewer homes that are selling above asking price. I wouldn't put this on social media, just being real with you, but this is a conversation that I would have with a buyer. Like if a buyer is saying, oh, I think I'm gonna wait, I'm gonna say, well, wait a second. We have a wave of demand coming into the marketplace. We already know that we're trending towards a recession, and if we trend towards a recession, it doesn't mean that prices are gonna drop, it does mean that interest rates are gonna drop, so you're gonna have the ability to refi. And right now, it's a little bit of a more vulnerable market to go after a seller. Why are you waiting? Foreclosure activity. Look at foreclosures in 07, 08, 09, 010. Look at foreclosures today. It's night and day. So think about the reason why I'm going through all of these different thought processes, because where's inventory going to come from? Where's supply going to come from? Where's demand going to go? Well, we know demand's going to be there because of populations. What about supply? Where does supply come from? It comes from builders. It comes from sellers, people just trying to sell their house. It comes from foreclosures. Well, builders aren't building. Banks aren't getting foreclosures right now. There's very little in terms of the foreclosure business. Anybody who does REO knows that it's dead. The reality is where are these sources coming from in terms of demand, in terms of supply? And on top of that, 20% of the market last year was purchased by institutional investors. 20%. So you have this whole population, the Blackstones of the world, that are going out and buying crazy thousands and thousands of homes to keep them as rentals. You think that helps the supply and demand situation? I don't even know what I wanted to show here. So, part 5. We'll talk about the shift. So, here are 5 things that I did differently during the shift that I would suggest you do differently. And this is the end of this. Jiujitsu. So I don't know how to do karate or jiujitsu or any of martial arts, but I do know what jiujitsu is. And it's basically, what it is you're using people's momentum against them. So in the thought process of why am I saying jiujitsu is the number one thing that you should do? Because if you think about it, the headlines work against you in down markets, but they can also work in your favor if you leverage them correctly. So the number one thing is leverage headlines. If you're walking into a seller's house and they're telling you, Michael, I know you say that my house is worth X, but I believe it's X plus $100,000. I would say, I completely understand that, but look at what the Wall Street Journal said yesterday. Because they see this, it's not like they have no idea that this exists, but it's not fun coming from you. You don't want to be the bearer of bad news, but if you leverage the headlines properly, then you're positioning them to make smart decisions, and you're not between a bullet and a target. Because if you tell them your house is not worth it, they're going to think you hate their house. And they're gonna think, well, if you hate my house, then you clearly are not the right person to market it, because that, other guy, around the corner told me that my house is worth more and he believes in my house. Well, I used to flip that. Jiujitsu is like, I'm using the momentum in the market against them, against the seller. Really, it's for the seller because it's helping them make smart decisions. But I'm using it against the other agent because what I'm saying to them is like, anybody could walk in your house and tell you exactly what you want to hear. That's easy. But like, they're not looking out for your best interest. They're just trying to get you under contract, to sign a listing so that they could eventually drop your price, because there's a strategy in real estate that you can't drop the price on a listing you don't have. Like, I don't believe in that philosophy. I want to get you top dollar. And I know that the market is trending downward right now, which means time is not your friend, it's your enemy. It's going to hurt you. So if time is working against you, like, let me show you the reasons why you should make smart decisions. It's not my opinion. The Wall Street Journal is saying it. Start to leverage headlines. You have to be smart about that. And here's the beautiful thing. You don't have to compile anything. One of the things that I started using when I was in sales is Keeping Current Matters. It's such an awesome tool if you've never heard of it. I pay for a subscription. It comes out monthly. You guys could use my subscription. What Keeping Current Matters does is it basically takes all of these different headlines and clippings from all these different places, and it compiles it into PowerPoint slides that you could use when you sit on a presentation. So here's what I used to do. I would walk in on a listing presentation, and I didn't like to bring a lot of stuff. Like, it was more of a conversation for me, but I used to have like a bag of the Keeping Current Matters slides that if I needed to prove a point when they weren't getting it, I would just whip the slides out and I'd be like, boom, 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 boom. And I would just throw all these different things like, let me show you this. Oh, that's your objection? Let me show you this. That's your objection? And I would keep it moving. And by the time I was done, it would be all in front of them and they would be like, whew, I get it. And it's a different conversation than I hate you because you don't believe in the price of my house. You have to be able to, it's diplomacy is really what it is. Number 2, setting expectations. This is a big one. So setting expectations, I'm going to bring up a couple quotes. I'll sell your house first weekend with 15 offers. Bad idea. Do not have that conversation with the seller because you're setting yourself up for failure. First of all, how many people have seen more than 3 houses in the past few months that have gone with 15 offers? Probably not many, if any. Couple? So people are like, I don't want to raise my hand. The truth of it is like, if I would have asked that question a year ago, everybody would have raised their hand. It's a different market. It's changing. So you can't set the wrong expectations because all you're doing is setting yourself up for failure. You're going to get a pissed off client. There is 0 chance you are getting that price. Equally bad idea. The conversation is not to insult them. The conversation is not to piss them off. It's to get the listing. Like people, like in presidential elections, like a lot of times people vote on the person they want to have a beer with. Like, it's the same thing. Likability matters. Like if you walk into a house and they hate your guts because of what you told them, you're going to have a tough time getting a listing signed. So it's a dance. It's a delicate dance because you're trying to dance the line between telling them what they need to hear but not pissing them off. And that's not always easy as the market turns. So getting really good at that, and what it looks like in my mind is, and this is not the right answer, this is my answer, is anyone can tell you what you want to hear. I'm going to show you what you need to know to make a smart, educated decision for yourself. Because I'm not the decision maker. They're the decision maker. I'm respecting the fact that it's their decision. And I learned this the hard way. I learned this because I was beating up a friend of mine's mother. Like, that came out really wrong.
Bad idea.
Verbally. I was, listen, I really cared for this woman. I did. I genuinely cared about her. She was like, a family friend for years. And she came to me. She was not interviewing anyone else. I was the person she was listing with. And I talked myself out of the listing because I knew that the market was going like this every month. And I knew that she had to be at a specific price because I knew the market better than anybody. And I was right. I was definitely right. I didn't get the listing. And I didn't get the listing because I told her, you got to be at 450, you got to be at 450 or whatever it was. And for an hour and a half, she told me why she wanted to be at 500 or 475 or whatever it was. And I was like, you don't understand. It's going to crush you and all this stuff. And I showed her every chart under the sun, but I didn't listen to my client. And she didn't list with me. and I was right. It sold for under the number that I had told her, but somebody else cashed the check. And it worked out to her disadvantage because she got somebody who just told her what she wanted to hear, and it really hurt her. Like, so it didn't work out for me, it didn't work out for her. She inevitably knew I was right, but what's the point of being right? I'd rather be happy and cash a check and help a client. So to me, like, you have to position it in a way like, I'm gonna show you the facts so you can make a smart decision for yourself. And then listen to them. Good idea. Number 3, understanding time. This is one that, let me just do a show of hands here. Who started in real estate after 2013? Most of the room? Okay. You have seen the market go like this for your whole career. And the interesting thing about that is the way that people view the relationship with a listing, a seller, is different when all you've known is this. Because you have no concept of time as it relates to a listing, respectfully. So when you think about time and a listing, like, I joked about this at the last session, maybe 2 sessions ago, about like somebody walking into my office and saying, like, it didn't sell the first weekend, what do I do? I was like, well, you have a 6-month listing period. Like, you take a deep breath. Like, that's the truth of it. So you, like, the thought process is you're not going to sell things the first weekend always. That's not how the market works. And here's the trick to understanding time. A lot of people came to me, and you get this question, what are you doing to market my house? That's the question that comes up when the house doesn't sell. It's not the market, it's you and how you market. So, and anybody who's been doing this in a downturn understands this very well. But here's the thing, like, people would come to me, for the last few years complaining about listing concierge. And the complaint was this: I don't even know why I would use it. The house sells before I even get to use any of the marketing. Like, it didn't even come out. Like, I sold it the first weekend, and like, I don't understand, because it doesn't trigger the next marketing piece until a week from now. So why would I use that? Well, here's the reason why you would use that. Because in a market where it doesn't sell the first weekend, the number one thing that you need to be able to do with a seller is tell them the next thing that you're doing for them for marketing. So if you just shoot one shot first weekend and then you got nothing to follow it up, they're gonna be like, what do you mean you're done marketing my house? No, it didn't sell yet. What are you gonna do next? What's the next piece? And you're gonna look really stupid, and you're gonna have a really tough time with that seller if you don't have an answer that comes next. The cool part about Listing Concierge, the reason why I love this program, is there's a lot of what's next. It's constantly, this is coming, this is coming, this is coming. You have to be better prepared to sit down with your seller and explain to them about a time-lapsed, or how do you say it? Timing the marketing campaign. You have to be able to speak to that. Hey, listen, this is what we're gonna do to start with. And well, I don't understand. What if it sells the first weekend? If it sells the first weekend, that's a good thing. Like, we want it to sell the first weekend. But if it doesn't, here's our plan. Here's what we're gonna do next. Here's what we're gonna do next. Here's what we're gonna do next. It will help you, and it will also help you in terms of price drops. Because what you're gonna have to position yourself, and you have to start thinking along these lines, is if the house needs to get a price reduction, which we're seeing a lot more of those now than we've seen in years, if we start to need price drops, that is a renegotiation with the seller. It's not like, you think sellers line up and say, drop my price next Tuesday, I can't wait. Like, that doesn't happen. Like, you have to set that conversation up. How do you set that conversation up? First of all, you set the right expectations from day one. Second, you're basically positioning them, here's all the marketing we're doing. And what Coldwell Banker does an awesome job on, and we take it for granted in good times, is positioning us with statistics that we don't use. So if you go into Coldwell Banker Insight, CB Insight, some of you don't even know what that is. CB Insight compiles all of the internet numbers. So like, how many people viewed a house on Zillow or Trulia or Realtor.com or ColdwellBanker.com, it compiles all that. When you're sitting in front of a seller for a price repositioning, you have certain things that you have to be able to speak to. You have to be able to speak to, oh, nobody saw your house? Well, here's the thing. we actually had 55 showings. Here's all of the showing time results that we had, or whatever system you use. Like, here's all the people that came to see your house. We had 5 open houses. Here's all the people that showed up to the 5 open houses. Here's all the people that saw your house on all the internet sites that we're on. Here's all the people that saw your house on Boost. Anybody who uses Listing Concierge, you get a report on Boost on how many thousands of people that went in front of. All of those things become crucially important in a changing market because you have to be able to speak to all of those different things and put them on the table, like I just said, and get them to understand that, hey, listen, it's not me trying to knock your house. It's not me trying to just, give your house away, because that's the other thing that you constantly hear. Like, you want it to be a fire sale. You know how many times I heard that? Like, I don't want it to be a fire sale. I want you to sell your house because that's your goal. Like, I'm trying to get you to achieve your goal. Here's how you have to do it. And you basically position and put those all in front of them. And now all of a sudden you have a really compelling argument where they can't tell you, you know what, Michael, like, you didn't even market my house. Oh, I didn't market it? I just showed you 55,000 people that saw your house. Like, really? Nobody saw it? It's me that's the problem? Like, you got to be able to change that narrative. That's how you do it. Number 4, we're almost done. You need to be vocal. You have to be vocal. And here's the reason why about being vocal. And I'm going to explain what this means in 1 second. It's this. It's times of uncertainty, people follow the certain. Well, here's the thing. If nobody hears your voice, they're not going to follow you. They don't know who you are. They don't know that you're certain. So you have to market. There's this, I love this quote. The market is for those that market. Like, that's what it is. So if you are a secret agent, you're going to get buried in this market. Like, no question about it, because it's so much harder to pick up clients in a downshifting market. It's hard. Like, and we're going to talk about that in number 5, but knowing that, what are you doing to position yourself as the expert in the marketplace? Because when people are in turmoil, when people see their value of their house worth less, when buyers don't know, do I buy now or do I buy a year from now, they want an expert. They'll list with their cousin when the market's going like this. They could care less. Like, oh, you have a real estate license and a pulse? Let's do it. Like, that's not the market we're in. Like, people change their whole feelings on that once the market shifts, because now it's like, wait a minute, I can't go hire anybody. I got to get the best of the best. Like, I'm not going to name names, but years ago we had a guy in our office that, debatable in terms of practices. Like, just put it that way. However, and this is really interesting, I got a call from a seller of this person's years ago, and they said, we want to meet with you. And they said to me, how can you work with him? He's the worst. And went on this whole thing about how this person is unethical and like a piece of garbage and like blah, 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 in every vulgar way you could imagine. And I sat there and I was like, whoa. And then at a certain point, I realized this is their listing agent. And so I said, he said, can I interrupt you for 1 second? And they said, yeah. And I said, I'm just curious. You're saying all of these horrible things about this person. And why did you list your house with them? And they go, oh, well, he's the best of the best. And we just need to we know, this is literally what they said to me. I swear to God. They said, we know he will lie, cheat, and steal to make $1. And we need somebody who will get us top dollar. That's what we care about. And I was like I was sitting there and I couldn't believe the conversation. I was like, clearly, I could not believe the conversation. But that's what you have to understand. I'm not saying be unethical at all, just to be clear. But you have to understand, people will list with the enemy, so to speak, because in this case, that's really how they felt. They will list with the enemy if it means it will get them where they want to go. So position yourself not as the enemy, position yourself as the expert and get them to feel comfortable with your certainty. And they're going to feel more comfortable working with you. But you got to do that by being vocal. Number 5, change your ratios. This is a big, big deal. You have to think differently about this. Tom Ferry, I'm going to send something out to all of you guys. And it's basically a Tom Ferry clip from Instagram. So I watched it and I was like, yeah, it was so spot on. It was perfect. But what Tom talks about is he's like, you know what? When the market changes, if you think that your ratio is, and I'm going to explain what ratios mean for 1 second. So if it takes you to get, you get in front of 50 people to close one piece of business right now, well, it might take you 100 people to close one piece of business in a shifting market. So like mentally, you have to change the way you approach this business from a ratio perspective. You have to get in front of more people, have to. I'll give you a certain couple of examples. Like when I was in this market, I was like, I'm not getting in front of enough people. So what did I do? I joined BNI, a business networking group. I got on the zoning board. I got appointed to the zoning board in New Providence. Why did I get appointed to the zoning board? Because one, it got me in front of more people, and two, it gave me that credibility that people were looking for. People wanted certainty. Who's more certain than somebody who has an official position with the town? Like, it made sense in that marketplace. I got very involved in the real estate community. And I got to tell you, it led to a lot of referral business. Like, I got involved with New Jersey Realtors. I'm still to this day a trustee on the board. I'm involved. I literally started the YPN for the state of New Jersey. I started the YPN for the board. I started to build all these things out to get in front of more people. Like, I also went to the bar, like being real. I was 21, 22, 23, 24 in that range. Like, you don't think I went out and like socialized with people? Of course I did. Every person I met, take a business card. Like, not in exactly that order, but it wasn't like, nice to meet you, business card. No, it was more of like, hey, like let's talk, somehow slip real estate into the conversation and wind up with a piece of business. But the point is like you have to think differently about your ratios because they're gonna change. They're gonna change. And it's not your fault. It's nobody's fault. It's just that people are slower to make decisions in different markets, so you have to treat them differently. Otherwise, you're gonna keep doing what you're doing, expecting the same results, and you're gonna fail. And that's why so many people, that's why 1/4 of the people in the country and almost 1/3 of the people in New Jersey left real estate in a downshift. Some of those people were capable. I know people that were friends of mine that were capable agents. They just didn't shift the way that they were doing business. You have to shift. So, I'm done. I put some bonuses in there. You don't need the bonuses. It was just to ask you guys questions, but thank you so much. I hope you guys enjoyed today's session, and I'll see you on the 21st for our next session, which is all about my trip for the 30 Under 30 Mastermind.